Okay, today I want to talk to you about one of the most important topics that often gets overlooked when it comes to trading, and that is equity drawdown. Now, most aspiring traders, when they come into the markets for the first time, they don't even know what drawdown is, because generally speaking, and this is just general, not everyone, but generally speaking, most are focused more on how much money they can make. They're more focused on the profits than they are on the associated risk that you need to accept in order to achieve those profits. They're not really too bothered about how much they can lose, or certainly they're not thinking about it from the get-go. But as you know, all traders, doesn't matter who you are, all of us, we all have losses. It's part of what we do, right? So we have to know in advance, what is our acceptable level of risk, our acceptable level of drawdown that we can expect going forward. You know, trading is more about psychology than anything else. So we have to feel comfortable with this level of risk. We have to feel comfortable with the drawdown. We don't want it to be uncontrolled, but at a certain level that we feel happy with. So that when you do go into drawdown, when you do go into those consecutive losses, you don't start throwing your toys out with a pram, you're beating yourself up, taking on excessive risk to chase those losses because you now don't feel comfortable. So with drawdown, you've got to accept it. You've got to expect it, and you certainly have to respect it. Now, the best way, of course, is to have your strategy totally, thoroughly backtested over extensive data. I've done lots of videos on backtesting. You can go and check them out in your own time. The more data that you have in your backtesting, the better. You may even want to run it through some forward unseen data. Remember that? The Monte Carlo simulation that I did a video on maybe last year, I think it was, looking at unseen data. So you get the worst case scenario of what your drawdown could be if things go really, really bad. So let's start off now by looking and defining exactly what the drawdown is. So this is my definition of drawdown. It's basically the percentage difference from an equity high to a subsequent equity low. Let me explain. Here you've got an account starting off with, say, $1,000, trading away, making some decent profits, nice steady return, and you grow your account to $1,200. It's about a 20% return on investment there. Then, of course, you have your losing period. You have your drawdown period that we all have. And the account drops now to $1,100. You're still in profit. You're still up 10% from the starting balance, but now you've got a drawdown going on here. So you've given back $100. $100 of $1,200 is basically an 8% drawdown. So you've got an account here that's grown by 10%, but you've had to accept an 8% drawdown to get there. You've got to feel comfortable with that, if indeed that is the strategy you want to trade on into the future. And of course, this can go on again. So now we take the account up to $1,500. So there's a new equity high, but then of course we have the drawdown. We drop $300 back down to $1,200. So 300 divided by 15 would give you a drawdown of 20%. So again, you're still up in profit. You now made a 20% return on investment, but you've basically accepted a 20% drawdown as well. You've got to feel comfortable about that. So that's basically the definition or the way we calculate drawdown. Now I want to introduce you a different concept. Here we've got a chart here showing the balance. Now the balance is basically the return on investment. You'll often see strategies out there marketed, sold. They'll basically say how much percentage gain it's had over a period of time. Some of it out there that you see for sale, very, very impressive. In this example, $1,000 up to $3,000, that's a 300% return on investment. Really, really strong strategy there. But what you need to consider is not just the return on investment, the balance, but you need to look at the equity. Now the equity, often depicted on a chart, on a trading platform, shows you the balance plus or minus the open positions. Very, very important. You haven't established the loss or you haven't taken the profits. They are open trades. And that is basically the equity line. So in this example, our equity line, the yellow line, basically shows you what's happened to your open positions. You can see a nice steady balance growth there, but you have to accept these drawdown periods. Here you've got a drawdown of maybe 50%. So to get here, you've got to be comfortable that you're going to risk 50% of your account, you know, if you're going to go for that big 300% return on investment. And indeed it goes on again, and then you have another big drawdown as well. That comes into 80%. So what you see in terms of the return on investment isn't the full picture. You need to appreciate what the drawdown has been in that period, because that is basically the amount you're willing to risk of the account in order to trade that particular strategy. Often you'll see strategies like the martingale strategy have this type of equity and balance curve. And more often than not, at the end, well, you know what happens. They end up falling off the cliff and you give it all back. Not all of them, but I've seen many that do, because the drawdown here is basically becoming out of control. You need to risk a lot to get this great return on investment. Let's come back down to earth. Let's have a look here now. I always say, I reckon a really healthy target would be 5% a month. To achieve 5% a month is a tall order for most, but it certainly is achievable if you trade cautiously and using proper risk control. So 5% over 12 months, that's about an 80% return on investment. Very good, yeah. So you take $1,000 up to $1,800. But again, you have to consider your drawdown. Here, you've had an 80% drawdown. How are you going to feel? How are you going to feel if you're trading away and all of a sudden you experience this drawdown? It's now dropped 80%. Are you going to be comfortable with carrying on trading that strategy, knowing that most of your account has now gone? A big drawdown. So you need to know what your maximum drawdown really is likely to be in the worst case scenario, and of course feel comfortable with it. Here you've got an 80% drawdown. Again, it's quite a big challenge to carry on trading when you've seen your account wipe out by 80%. Now consider this, recovering from a drawdown. Not quite as simple as you may think. Don't just need to make the money back, you need to make a bigger percentage back, and it gets bigger and bigger depending on how big the drawdown is. Under control, if you have a loss of capital, a drawdown of just 5%, well, you only need to make 5.3% to get it back to break even, or to where it was before you started. If you lose, say, 20% of the account, well, that basically means you need to make 25% to get back to where you were before that drawdown happened. And as I say, it gets worse. Here, you drop 50%, you go to 50% drawdown. Can't just make 50% to get back. Oh no, because your capital is now from a lower base. You've got to make 100% return just to get back to break even to cover a 50% drawdown. 60%, you've got to make 150% on the account just to get back to break even. So recovering from an excessive drawdown is really difficult. I would say pretty much you'll end up blowing up the account if you're trying to return 150% of the account just to cover that 60% drawdown. Certainly worth noting. Just want to jump on to the screens now, and I'm going to show you some data on some other strategy testing software that you may have seen out there. Come on. Okay, so this is a very popular site that many traders use to monitor their own trading performance. Very good. You can just link it to your trading platform and it works out the calculations for you, the drawdown and so forth. People also use this site to follow other traders as well and to monitor what others are doing out there. Now I have blurred out the participants, the different systems, so as not to promote or not to talk badly about any particular system. So there you go. Right, let's have a quick look at this one here. This one caught my attention. Quite a good return on investment here since inception, up almost 490%. But the drawdown is very much in control here. 15% drawdown was the maximum drawdown, and a good monthly return as well, 4.3%. So this has been running for a while, clearly, but a very controlled drawdown. That's something that you may want to consider. And of course, if you zoom in as well, you can actually see the drawdown in relation to the equity. So that's not a bad one that caught my attention. Okay, so here is another one. See a nice positive equity line, but keep an eye out here to the right. You see this drawdown there comes in at 37.7. Nice healthy return, 560%. But are you going to be stomaching this when you see a 37% drawdown? It's quite a high drawdown. So that's why we look at the drawdown in relationship to the actual percentage gain. Gives you a good indication of how risky that strategy is. And finally, we'll take a look at this one. See here a really healthy looking gain there, 1,400% gain. But look at the drawdown, 80%. Are you going to trade a strategy where you've got an 80% drawdown? Chances are you could lose the entire account. That's got a high chance of blowing up when you have a drawdown such as 80%. That's why we pay attention to drawdown. So I get confronted with this all the time. People generally on their free trial when they come and join us at Forex Signals, they say, Andrew, I'm in a euro dollar position. I'm down 70%. What should I do? Is it going up or going down? Look, really sad when I get this type of message. So what should you do? Well, clearly, the first thing I say to them is, well, don't do it again. Now, I know if you're listening and you're in that type of situation at the moment, I feel for you, I really do. You've often heard them say in the past, the first cut is the cheapest. Maybe you should get out of the trade and look at it as a lesson learned, but I'm not going to tell you to cut your positions. That's entirely up to you. Hey, it may recover and you may get back at break even. But if it did recover and got back to break even, perhaps that's the worst thing that can happen to you. Like any problem, you need to confront it or it will happen again, but next time it could be a whole lot worse. I pretty much guarantee you'll end up blowing up the accounts if you're continuing to trade like that. So don't get yourself into uncomfortable drawdowns that will take a whole lot of miracles to get back to break even. But the first step in beating this is admitting it. So admit you're wrong, cut out the position and learn from it. I guess one way of looking at it would be this financial cost out of the trading account because you got into this uncomfortable drawdown was money well spent. You spent that on a good lesson learned. So what should you do to avoid getting into uncomfortable drawdown? Well, first off, you should use proper money management. Reduce that risk size. Reduce the risk size and make sure you always have stops in place to keep your losses at a predetermined maximum amount of the account. You know the theory of the coin toss, yeah? It's a 50-50 outcome. You do that, you're definitely going to have drawdown in that as well. You're going to have a series of consecutive heads or consecutive losses. You're going to have a drawdown using that. But if you're using minimum risk, if you're using a 0.25% risk or something like that on each account, it's very unlikely that you're going to get excessive drawdown that you simply won't be able to recover from. Some of you may be thinking about a career as a prop firm trader. That's basically when you pass a challenge, and if you pass the challenge, the prop firm will give you an account to trade and you can keep a share of the profits. A great way to trade if you're starting off with a limited account size. Now, the prop firm will set out parameters in this challenge to evaluate you as a trader, and drawdown is a key component. In my recent review that I did for the channel here a few weeks ago, I analysed a few of these prop firms. And I saw that the drawdown that they sort of accepted in their challenge ranged anything between 4 and 15%, which I think is quite realistic. These prop firms, these professional outfits, they know how important it is to respect drawdown. Now, we're currently running, in fact, some training inside our trading room for people that are wanting to succeed as a prop firm trader. So you can come and check that out if you wish to as well. Drawdown is a key component when you're evaluating the different prop firms that you may want to go to, but you can learn more about that should you wish to. So drawdown is so important. Okay, so I hope you found that useful. At least now you know what drawdown is and the best ways to try and avoid excessive drawdown. Okay, so leave me a comment, let me know what you think. Thumbs up, thumbs down, really appreciate it. We're pushing out this content each and every week. It really does help us with our ratings if you give us a thumbs up, indeed if you like the video. Don't forget now to subscribe to the channel if you don't already do so, and that bell notification does the trick, notifies you when the next video has been released. You can follow us on all the socials as per usual, and as you know, we are streaming live around the clock 5 days a week, 6 times a day. If you want to take part in that, come and chat to us here at Forex Signals. Just use the link in the description. It will take you to exactly where you want to go. There's a free trial as well, discussing market opportunities each and every day. I'm sure you'll love it if you give us a try. If that's not your thing, that's not a problem. I'll see you next week and have a good week.